I want to talk about the different type of risks that you face as an investor, because they are numerous, and there's an investment risk inherent in any type of investment that you make. So for example, if you're putting money in a CD or under the mattress, there are interest rates and inflation risks associated with that. Likewise, your more aggressive investment obviously have the risk of losing some or all the money that you put into them. So before we analyze an investment in your portfolio, we have to first look at what your risk propensity is and what your risk capacity is. Your risk propensity is simply what you feel you can stomach. You know, how comfortable are you with the level of risk that you're taking? And generally, that's done by assessing a numerical value. If you have $1 million portfolio and the Monte Carlo simulations that we run tell us that there's a 5% chance that you lose 30% of your portfolio, then the question from a risk propensity standpoint first is, if you lost $300,000, are you okay with that? Can you handle that type of risk? The second non-emotional aspect is the risk capacity. And that would suggest that if you lost $300,000 and now you have $700,000, does that affect your income so that now you would have to change the amount of income you're taking and you're not able to absorb that risk? So once we know what those numbers are, then we solve for return. Most people we see in planning do this completely the opposite, where they say, I need an 8% return, and they go out and build a portfolio that's designed to look for 8%. Well, the problem is, what if that 8% portfolio design does not match your risk? Then we've done everything backwards, because when you lose 30%, you realize then, after you've lost it, it's too late. So the first question is always, how much risk can I take? The way that we analyze risk is not too unlike the way that we analyze a return. A return is based upon the average annual return. Now, average annual return can vary from one case to the next. For example, two investors, each getting an average annual return of 10%, depending on the deviation of those investments, ended up with a completely different amount of money in the end. And so how much you deviate from your 10% return is extremely important. And then this average annual return that we've been conditioned to place so much emphasis on becomes all but meaningless, really, in the scheme of your portfolio. So as we look at what we call coefficients that measure your risk, the first one that we're looking at is your standard deviation. So when an investment makes 10% return over a decade, it had some peaks and some valleys. Those peaks and valleys can be measured. And when we measure those, we come up with a standard deviation that tells us how much we're deviating from the 10% return. It will affect how many dollars you have in 10 years. And that's, again, what's important, how much money ends up in your pocket. The other number that we're looking at when it comes to risk is a risk-adjusted return. The risk and return are two ends of a stick that you cannot separate. Alpha is the significant number that we're looking for. And the way that we derive alpha, which means the amount of return we're getting for the risk that we've designated to be comfortable taking, is we determine what our beta is. Okay, now these are complicated terms, but it's really quite simple. If I'm invested in a portfolio of mutual funds and exchange-traded funds and stocks and so forth, I can come up with a beta and derive from statistical analysis how much risk I'm taking relative to the stock market or the underlying index that I'm in. So if my index is a 1 beta, let's say the S&P is a 1, and my portfolio is a beta of 0.8, then my risk is about 20% less than the S&P. And if my alpha is positive, that means, let's suppose that my return was the same as the S&P, but my risk was 20% less. Well, that's a positive alpha. That's a positive number, and we always want to drive alpha in a portfolio. That's really the most important factor when we're looking at coefficients. So when you design your portfolio, if you already have one, just simply have somebody run an analysis to tell you what your standard deviation is, what is your beta, what is your alpha. And from there, you're going to be able to determine if you're getting a good risk-return trade-off. And what's great about knowing that is if you're not, then you can make some adjustments and you can fix that, rather than just kind of leave it alone and buy it and hold it and forget about it. You can actually be proactive and determine what type of strategies, what type of asset classes can be added to a portfolio to lower that beta and to drive that alpha up. That statistically can be done, and Harry Markowitz won a Nobel Prize for his thesis that this intelligent organization of asset classes can lower risk and simultaneously increase returns.